When most people think about capital in a family enterprise, they think about one thing: financial capital. But in reality, the strongest family enterprises are not built on financial capital alone. They're built on four types of capital. I will cover those shortly. And even one of them is neglected, the entire system becomes vulnerable. In family offices and their family enterprises, financial capital tends to get the most attention, understandably so. It is measured, it is tracked, it is optimized. But over time, I have seen that financial capital is often the easiest part to manage. It's the numbers, black and white. The harder part is everything around it. Financial capital is the first layer, the most visible layer. For avoidance of doubt, that includes investments, cash flow, real estate, private equity, public markets, private markets. This is where most of the focus goes because, after all, the family office manages the family wealth. However, financial capital is only one layer of the system. The second important layer is human capital. This is the capability of the next generation, for example, the decision making ability of family members, the presence of experienced operators and advisors. Many families assume that human capital will develop naturally. However, without intentional development, capability gaps emerge, confidence is uneven, decision making becomes inconsistent or difficult, and that directly impacts outcomes, including financial ones. Governance is the operating system of the family. That is the third type of capital. This is how decisions are made and who makes those decisions. It includes decision rights, investment and process frameworks, family constitution and guiding principles, roles and accountability, and so much more. Governance is, in fact, the operating system of the enterprise. And when it is unclear or informal, even strong financial and human capital may be misallocated. The fourth part of important capital is reputational capital. This includes how the family is perceived externally, relationships with partners, lenders, operators, the family's brand, and how it evolves over time. Reputational capital compounds, but it can also erode quickly. And once damaged, it is difficult to rebuild. Here is the one or takeaway or key insight I would like to share with you. These four forms of capital are all interconnected, and all important. For example, if governance is weak, financial capital can be misallocated. If human capital is underdeveloped, decisions become inconsistent or difficult to make. If reputational capital is damaged, opportunities become limited. Over time, financial capital reflects all of the above. A simple question to consider is this: where are you spending most of your time and attention? And which form of capital are you unintentionally neglecting? Because the strength of a family enterprise is not determined by one type of capital alone. It is determined by how well all four are developed and aligned. This is a framework I often use when working with family offices and their family enterprises, not just to evaluate investments, but to evaluate the strength of the system as a whole. So, if this perspective resonates, I'm always happy to continue the conversation one on one or be a second set of eyes as you think through your own structure.